It's hard to fully convey the impact William O'Neill had on the field of stock trading. Starting from humble beginnings, O'Neill was able to parlay an initial investment of $5,000 into over $200,000, and then later into a multi-million-dollar account. Not only that, he started his own newspaper and has written what many consider to be the Bible of growth stock trading, How to Make Money in Stocks. Best testament to O'Neill's knowledge of the stock market is that many of his disciples credit his teachings as a turning point in their careers. Furthermore, some even went on to win the U.S. Investing Championship, including David Ryan and Mark Minervini. Life was by no means easy for O'Neill growing up in Oklahoma. Born during the heart of the Great Depression, he quickly learned the value of hard work and saving and investing. After serving in the United States Air Force, O'Neill started out as a broker at Hayden Stone. It may surprise many to hear this, but O'Neill was actually the worst performing broker at the firm. It was his desire to turn his returns around that actually motivated O'Neill to study the characteristics of the biggest winning stocks. Let's take a look at some of O'Neill's core trading principles. Number 1, buy stocks coming out of bases. Like most traders, O'Neill originally didn't know how to time his entries. During the 1950s, the Dreyfus Fund was drastically outperforming every other fund on Wall Street. William O'Neill did some research and plotted Jack Dreyfus's buys across some charts. O'Neill noted that Dreyfus, like Livermore before him, loved to buy stocks breaking out to new highs. Building off the work of Jesse Livermore, Nicholas Darvas, Jack Dreyfus, and William Giller, O'Neill popularized the cup and handle base. He loved to buy stocks emerging from these patterns as they broke out with volume coming in. One of O'Neill's first huge winners was in Chrysler in 1962, as it emerged from a cup and handle base. O'Neill also popularized the high tide flag pattern. These are stocks that double in 8 weeks or less and then consolidate less than 25% over the following 3 to 5 weeks before breaking out again. O'Neill made a fortune trading syntax in the 1960s coming out of one of these patterns. Number 2, cut your losses. O'Neill made it a rule to cut his losses at 8%, with many of his losing trades coming much sooner. The reason for this is simple. Holding losses can devastate a trader. Losing trades tie up your account and your mental capital. O'Neill believed the only good stock was the one that was going up, and the fact that a stock was falling was the only indication he needed to sell. After all, if the stock was so good, why was it going down? If you want to be successful, you need to draw a line in the sand and make a commitment to cut your losses quickly before they get out of hand. Number 3, strong earnings and sales growth. O'Neill understood that Wall Street loves new and exciting companies. That is why he made it a point to focus on stocks that were growing their earnings and sales rapidly. The founder of IBD liked to see quarter-over-quarter earnings grow by at least 25% and annual earnings grow over 25% as well. He also wanted strong sales growth in companies. His favorite scenario was when quarterly earnings and sales were both accelerating, as this was a clear sign something exciting was going on. To learn more about fundamental analysis, see my previous video. Number 4, new products, new CEOs, new highs. New. Wall Street loves to hear something new is taking place. It can be a new CEO, a new product, or even a new industry. O'Neill was always on the lookout for new products. In the 1960s, when Syntax came out with a birth control pill, O'Neill bought the stock as it emerged from a high tide flag pattern. Jumping aboard this new and groundbreaking product helped O'Neill to build his fortune. Decades later, he was quick to realize the importance of the internet and captured huge winners in stocks like AOL, Charles Schwab, and Qualcomm as they broke out of classic cup and handle bases. Number 5, supply and demand. At its core, the stock market is governed by supply and demand, and William O'Neill understood this. The formula is simple. Increased demand combined with a limited supply will force prices higher. To capitalize on this fact, O'Neill favored stocks with a smaller supply of shares, especially if the company was buying back their own stock. In addition, he was often wary of stocks with excessive stock splits, as he noted this could be a sign of a major top. Number 6, leaders. Would you rather have a Coca-Cola or an RC Cola? What about sneakers? Would you rather wear Nikes or the new pair of Payless shoes? How about your internet searches? Do you want to use Google or Ask Jeeves? The concept is simple. You want to buy the leader of any group. Now, there are a few ways to measure this. The first would be to look for stocks with the strongest earnings and sales. The simplest and most effective way, however, is to look at the price action of the stock. Investors Business Daily developed a proprietary rating to quickly and easily see which stocks are outperforming the market. An RS rating of 99 or higher would indicate that the stock was outperforming 99% or more of the stocks in IBD's database. O'Neill made it a point to stick to stocks with an RS rating of 80 or above, with the vast majority of his buys coming from stocks with relative strength ratings of 89 or higher. The best time to use the RS rating is actually during market corrections. This is when the strongest stocks will really stand out, as they resist the downtrend while most other stocks fall day after day, week after week, or even month after month. A great example of this was Amgen in 1990. Notice how it was actually heading higher while the market was still bottoming in 1990. It's no surprise then that O'Neill was buying it as it emerged from its base and broke out into new high ground. Remember, bear markets and corrections are not a time to tune out the market or forget about trading. It's a time to dig into your research and to be on the lookout for the new leaders, the stocks with the strongest earnings and sales that are resisting the market and holding up relatively well. Number 7, institutional demand. When you begin to study charts, high volume accumulation becomes apparent. You can clearly see in the chart how volume is showing up and coming into a stock. That type of volume that you see is not your cousin Mike or Aunt Susie buying. It's a big fund or institution coming in to buy thousands or even millions of shares. Because institutions have large buying power, it makes sense to monitor their actions in hopes of buying stocks that are in strong demand. In addition to using charts, O'Neill also liked to review what top performing funds were buying. When researching a stock, if O'Neill noted that a well-known fund, such as the Fidelity Contra Fund, also owned the stock, that was always an added bonus. Number 8, general market. You've most likely heard the phrase a rising tide lifts all boats, and the same thing goes for the market. It has been noted that 75% of stocks will move in the same direction as the general market. O'Neill believed this was such a huge factor in a stock's success that he once remarked if he could do things all over again, he'd put the M in CANSLIM at the beginning. To gauge general market health, O'Neill would look for high volume distribution days on the general indexes. You can see how in 2020, heavy volume selling or distribution began to come into the market prior to the downturn. O'Neill also developed his follow-through day concept to prepare for changes in trend. After the market had been in correction, O'Neill would watch the market for the first 3 days after a low. Then, on day 4 or later, he'd look for a large volume accumulation day, especially on days 4 to 7. While not a perfect signal, follow-through days are often considered a buy switch that notify traders to be on the lookout for stocks to buy in case the bottom is truly in. Sadly, William O'Neill died in the spring of 2023. Although he has passed on, O'Neill's legacy lives on as thousands continue to read the books he wrote and the newspaper he started. There's no exaggeration in stating that as long as there are financial markets to trade, William O'Neill will continue to be studied and regarded as one of the greatest trading minds to ever live.